Casey Cavell, welcome to Built to Sell Radio.
John, great to be here.
It's great to have you because, as I was saying before we hit record, I am not only a fan of your podcast, but also I'm a customer. So I've taken my kids to a DBAT facility, and I think that's awesome. Tell me how you got into the business of DBAT. Explain what the business is and how you got into it.
Yeah, so I've been kind of serial entrepreneur, got involved in buying businesses early in my early 20s. I was actually a professional poker player, dropped out of college. This was in like the boom of 2006, 2007, where it was on TV and it went mainstream and everybody thought they could do it. And I was a guy that just like read the books and studied and was mentally fit, was physically fit, knew the math. And, there's a little bit of skill behind it. And if you do something that has a little bit of skill involved over a long period of time, you usually win. But I realized, John, that wasn't the lifestyle I wanted to live. So I took kind of my winnings and started investing in buying self-storage facilities and apartment complexes early on. And
you were before Nick Huber. We've had Nick Huber on the show, and Nick talked a lot about self-storage and how he's kind of really transformed himself from one entrepreneur. Now he's into we know a lot about self-storage. But how did you go from self-storage to DBAT?
So I had an exit, had a few dollars in the bank, and I started saying, okay, what would I do if I knew I couldn't fail? And it was something around baseball, because I was a baseball guy, played in college, but it was also around business. So I was trying to figure out a way to mix what I love with business and make money and make an impact and all of that. So I started Googling baseball franchises because I like the idea of a franchise, because I was like, hey, if somebody else has already figured this out, maybe I can do it similar, right? So I called them up. They were a franchise. They only had like 7 or 8 units at the time. They were only in Dallas, Texas. And I was their first franchise out of the state of Texas. And they connected me with somebody that was in Atlanta that had an all sports academy. This gentleman owned a hedge fund, and he was a hedge fund manager. And how it goes is people with a lot of money that are passively investing in businesses, they don't really do really well. And he invested $3 million into this complex, 40,000 square foot indoor complex, and it just didn't work. And he basically said, hey, here's the keys. Can you take this over? And I implemented this new model in there. So that's kind of how I came to find out about it.
Okay, more detail. So the DBAT is a company based in Texas. And for folks who don't know DBAT, it's a batting facility, a baseball facility with batting cages and all kinds of training stuff. So for kind of avid kids who are aspiring players and so forth. So you come across this facility in Atlanta that was a multi-sport facility, not focused on baseball. To be clear, was it a DBAT franchise?
It wasn't. It was called Top Dog Sports, and they did like all the sports. And I mean, they did soccer and softball and lacrosse and weightlifting and sports performance. And I realized it was a really good baseball market. And as a lot of our listeners know, the more niche you can get, the more success you'll have. And they didn't really own any niche. And I said, hey, all right, if I can take what DBAT's doing really well in Texas in a similar market, there seems to be a similar need here. And if I could just focus on baseball and softball, I would do really well. So I bought him out, kind of took over the lease, saved him a bunch of money on guarantees and all of that kind of stuff. He gave me his email list, which had several thousand people. And then I just said, hey, this is who we are now. This is what we do.
And when you say this is who we are, you bought a DBAT franchise?
Correct.
Okay. So you bought a DBAT franchise, and it sounds like you kind of took over Top Dog without an exchange of money. You just said, look, I'll take over the leases, basically the obligations, but I'm not kicking in any extra cash. Was that how you got into it? Or
I wrote him a $150,000 note that I had to make due over the next 3 years. So I was paying him a couple grand a month for kind of the goodwill and all that kind of stuff.
Okay. So $150,000 note, meaning effectively it was a debt that you owed him, and you took money from the company to pay it back, and you took over the leases, which would have been, if it was a headache for him, it would have been a big deal to get those taken over. So that's a lot of debt. Did you personally guarantee the leases?
Yeah, we did. I think we probably had a 5-year guarantee on that lease. I was in my mid 20s, right? So I was at a point where I could take a lot of risk. I'm 30 something now, right? 38 now. Yeah. So looking back at it, would I have done it again? I don't know. But I just said, hey, if other people are doing something similar, which they were in another market, could I do it better than them? And if I can say yes to that question and they're profitable, then I know I'm going to be profitable. And I just took a business-minded approach, not just a baseball-minded approach, but a business-minded approach to baseball. And there's not a lot of like strategically thinking people running these sports academies because they get in it because they're passionate about the product, but they don't know how to do all the other things outside of just delivering the service.
Got it. And so what did a DBAT franchise run you? How much did that cost?
Yeah, I think a franchise fee was $35,000 or $40,000 at the time ish, right? And to get these things started today from the ground up, they're, $500 to $1 million. Now, a lot of that is the build out of the building. Now, the good news with this is a lot of the build out was already done. I just went in and put new lights and put new turf and put new machines and put in a pro shop. So a lot of the build out was done. So I was almost halfway there.
Okay, so you're $35K into DBAT, $150,000 note. You take on this big obligation for the lease. How much was the lease? And I'm trying to. How long was the lease for? And again, I'm trying to get a sense of what the financial commitment was that you were taking on. How long was the lease, and how much per month? In other words, if you had defaulted on the lease, what was the obligation you would have inherited?
I think it was about a $300,000 or $400,000 liability. I think our payment was $10,000 to $12,000 a month, and it was a 3 or 4 year out on it.
And who's ours? Is this you and your wife, or who is the teammate in this?
This was me at the time. So I went in and made the investment and got the thing started. I had a minority partner that started kind of early on, but I realized like 6 months in, he realized that I can't really help you run the day-to-day, and that's what I needed. So I bought him out as well. But I think I was in the 150 note. We put another $250,000 in improvements. I had another $50,000 investor. So I was probably in $400,000-ish in cash at the end of the day. And I had that kind of that note I had to pay off as well.
Wow, you've done pretty well for yourself as a poker player and early in the self-storage. I mean, you were still in your 20s and you had, big chunk of change to throw around into this business.
Yeah, it worked. And, I just surrounded myself with the right types of people, I think early on, that have already been there and done that, whether it was in the self-storage industry or why I bought a franchise, because the CEO of DBAT, I really liked him. I trusted him. He'd been there and done that. And I just kind of said, all right, what would you do if you were me? And I kind of put it through my own filter and just made it happen.
In retrospect, do you think buying the franchise was worth it? Why not? I guess some people are listening saying, but Casey, baseball, you could have just set it up without the DBAT franchise. Or, was like in the long, like as you think back now, was it worth it having a DBAT franchise?
I guess it just depends on your overall vision. My vision was just to have 5 locations around the Atlanta area and kind of be happy with that. Now, if I wanted to take over the world and own every academy and own every market, probably not. But I also liked the team at DBAT and what they taught me and their experience, and they got me there quicker. I love learning from other people's mistakes rather than learning from my own. And they made some because they've been doing this for 8 to 10 years before I even got in. So it got me there quicker. Now, 3-5 years into it, did I know a lot of things? Yeah, I did. But I also had opportunities to do consulting and advisory for other franchises. So it just kind of worked itself out. And I just think if you can align with values, aligned people, whether they're an advisor or an investor or whatever, that have been there and done that, like it just makes life easier. And for me, is money important? Yeah, I think it's a way to keep score, but it's also like who you're working with and is it fun? And it was more fun and more enjoyable to work alongside them.
I want to dig deeper into your vision, because I think it's really unique that your vision was 5 locations around Atlanta. What little I know of you now, I observe a really ambitious, very successful, like you read the books to do the poker. Like not many people have that stick-to-itiveness, the desire to read the books, and you did. You won. It strikes me that someone in their 20s, it would be more common for them to have the bravado that would be like, I don't need DBAT. I'm going to take on the world. I'm going to have 100 locations around the world. And yet you didn't. And that makes me curious as to why 5 locations? What was it about that size business, that sort of entity that felt like a good goal? Do you know what I'm asking?
Yeah. I think I had some self-limiting beliefs, honestly. My dad was an entrepreneur, and I saw some of his failures and some of the things that he tried to do and go big on that just didn't work. So I'm just like, I don't want to do that, right? Like I saw how some of those things impacted myself, my siblings, my mom. So I was like, is it worth it? Right? Is it worth taking out all of this risk and doing this? So I think that was a little bit of it. And I was young and I was smart enough to know even back then, I just didn't know how to do it. And I'm like, if somebody else can help, great. And I'm a big believer that you just want to learn, especially in your 20s and your 30s, like learn. You'll earn later on down the road. So I think that was just as much it as anything is who can I learn from? Who can I do this with? And then the 5 was, we just kind of looked at what was already done in another market in Dallas and said, all right, they have similar populations, there's similar amount of customers, there's similar amount of income levels. All right, we could put one here, and here. All right, great, let's do it. And then I basically signed up to build 5. So I kind of prepaid some of those other franchise fees. So I kind of pot committed myself and said, I'm in 4 or 5. I have to do it. Because I knew like once I made an investment, I was going to do it because business is hard. It's a lot harder than obviously everybody listening. It's difficult, but when you make that investment, whether it's emotionally or financially, like you're in.
And were you thinking at the time when you bought those 5 franchises, those locations, were you thinking, I'll flip these down the road, similar to the way you did the self-storage business? Or were you thinking, I'm a baseball guy. I want this forever. I'm a lifestyle entrepreneur and I want to own. Do you know what I'm asking?
I didn't really know, which might have been the norm for a lot of entrepreneurs. I saw an opportunity and I wanted to take advantage of it. I think a lot of people get too far out in the future of what's it going to be when they're like, all right, well, what do I want this thing to do a year from now or 3 years from now? So I knew if I could just do one really well, all right, I could probably do another. And then who knows kind of what happened from there.
So you get into the first one, which was Top Dog, and you rebranded and bought new, upgraded the facility and so forth. How did that go? How was the first facility? What was explain the economics of it?
The business was basically shut down. There was no customers for 6 months, and we opened up and we generated, I think, 1.5 million or so in revenue in our first 12 months. So it was really good. But I worked really hard. And the mistake that I made, John, is I kind of did a little bit better than the previous business as far as niche. Okay, we're just doing baseball and softball, but I didn't even niche farther down, meaning, we're a baseball and softball academy. Well, what does that mean? Slow pitch softball, fast pitch softball. Does that mean adult league softball, church league softball, baseball? Okay. Is that professional players? Is that college players or high school or little league? So I was chasing a lot of different opportunities in the first year, which we made money. We were profitable. But when I figured out who are the customers that we really love serving, who are the customers that nobody else is going at, or at least I know by serving that niche, like we can be the best in the world at it. And I realized, John, it wasn't the travel ball player or the professional player, which we had the Jason Haywards of the world, right? The Dexter Fowlers of the world, we had all the pros that come in during the day, but they weren't paying us. We just said, hey, come in for free, hang out, right? Let us use your name that, hey, this is the place that the pros train. Our niche ended up being like the 5 to 10-year-old kid because one, we loved working with 5 to 10-year-olds. They were fun. Like most 5 to 10-year-olds, as long as they're not your own, right? They're fun to hang out with and fun to be with, right? And nobody else was serving that niche. And, ultimately they made us the most money because we had multiple revenue streams in baseball. They could come to our camps or birthday parties or pitching machines or lessons. Well, a 13-year-old kid's not having his 13-year-old birthday party at DBAT, right? Or a 17-year-old kid's not coming to a baseball camp. So we had to niche down. And when we did that into our second year, the business it just took off. And it was a lot more fun and it was a little bit easier to manage.
A lot of people saying, yeah, but you gave up a lot of revenue, not taking the travel ball team stuff. I don't know. I'm not sure I could do that. Just walk through the economics of making that change, of really focusing on the 5 to 10. So you had $1.5 million in revenue, profitable in year one. Where did it go from there?
We kind of plateaued in that 1.5, 1.7 range, but it was more profitable revenue. And it was,
give me a sense of the percentage of like profitability. Like how much was it before?
We were 35 to 40% profitability on that business.
Wow. What was it before?
It was probably half of that.
Wow. Okay. So it had a huge impact, not necessarily on the top line, but more on the bottom line.
Yeah. I mean, we realized a camp with 10 kids in it for one instructor, the profit margins were a lot better than one-on-one lesson with a high school kid. So let's just focus all of our energy on that. And we only had so much space, right? We're not like a service-based business where you can just keep growing and scaling. And we had some confinements, and that's why we couldn't grow. That's why we had to add more locations. But yeah, giving up revenue or giving up potential customers to find more of the better ones, it's always a good decision. It's always hard for a business to figure that out or realize that. But once they do, they're in better shape.
Got it. So you're niched down to the 5 to 10-year-old market, camps, birthday parties, and so forth. I get it totally. What triggered you to want to start a second location?
So I was honestly burnt out of the first one. So first year, 1.2, 1.5-ish in revenue, right? I was doing it all myself. Second year, I was still doing it all myself because I realized, hey, if I go in and bring in a 6-figure type of salary in here, there goes a little bit of my profit. So it was a very hard business. Yeah, it was a very hard business to get out of the day-to-day. And for me, a business should make money without the owner being there. And it was making money without me being there, but it wouldn't make nearly as much. And for me, like, I want to be great at everything I did. And it wasn't something that I could just leave and go do something else and everything's going to work, because the caliber of people I could hire, that even was a self-limiting belief. Like, I didn't realize that if you hire better people, they could actually make you more. Right. And that's where I probably got it wrong, is I underpaid people. I didn't get people bought into the bottom line. Like, I just didn't know how to do those things. So I had this successful business, but I was ready just to say, all right, let's sell it. Let's move on. Let's take some time off and do something else. Although it was baseball and it's what I loved. If you do anything too much of what you love, it eventually becomes kind of tough. And I was having to do everything. And that's where I think a lot of business owners, whether they want to sell their business, like, figure out a way to sell your business, but it can't be relying on you. And that's going to increase your valuation and all of that kind of stuff. So that's how it happened.
Okay. So you got the one location, you made the big change to focus. You're now at 35% profit margins. What happens next? Is that when you did sell part of the business to?
Yeah. I went to some
walk it through that.
Yeah, I went to some local business brokers that I knew and started calling and texting everybody and said, hey, look, do you know anybody that wants to make an investment and buy this business? Because I almost had to portray that, okay, I'm good. The business is good. But if you would have removed me from that business, like, it would have went down, just because we had one location and I was the engine behind it. So I was trying to sell a business that was really relying on me, and people weren't really buying it. They were like, Casey, if you're removed in this business, what am I really buying here? Because people don't want to buy a job, right? They want to buy an entity and something that makes money without them, an engine. So I quickly realized,
Casey, how did they evaluate that when they were looking at your business? How did they get a sense that it was dependent on you? Because on the outside, it doesn't sound like it would be that dependent on you. It's a baseball facility. You run birthday parties. I mean, you don't need to have a really senior person to run 5 to 10-year-old birthday parties and that kind of stuff. So how did they look at this business and say, Casey's it's too dependent on Casey?
I was the general manager. I was the COO, head of operations, head of birthday parties. Like, I was literally doing the majority of that. And my highest paid person on staff was like $13 or $14 an hour. Right. So they realized, like, if he's gone, well, who's doing it? And if I buy, then who's replacing you? And I just didn't have that person.
Got it. And help me square one other thing. So you're thinking of selling this one location, but haven't you committed to building out 4 other locations? Were you still intending to build out those 4 other locations, or were you totally burned out? Help me understand that.
Yeah, at this point, I was done. I was like,
so
okay, I can.
You were going to walk away from that.
yeah, I was going to use that and say, hey, if you want, you can use these other licenses to, I was going to kind of sell those licenses with it to let them know, hey, if you want to be the one to build 5 more of these things, great. But I just couldn't see myself starting another one because I just at the time wasn't smart enough to realize, all right, I have to hire really great people that are better than me, that are smarter than me, that are more savvy than me, that have been there and done that. I have to pay them really well. And I have to build a business that didn't rely on me, like systems and processes and all of that, because it just didn't exist. It was a newer franchise and every location is different. And I just didn't realize that I needed to invest in good people and good processes. And I was ready to kind of give it up.
Okay, so this is really interesting. So the brokers are looking at this saying, yeah, but it's too dependent on you, Casey. So where does it go from there?
One of the business brokers reached out to me and said, hey, I know a guy that might be really interested. He was in the process of getting a company acquired. He was a stakeholder in a very successful business. And he was, 20 years my senior and very much wiser than I ever was. And we met, we had lunch, and he goes, he started asking me a bunch of questions and saw my kind of skill set and my unique superpower per se, right, of the things I was good at. And he's like, just so you know, I'm not good at any of those things, but I am good at these things. And all of those things that he was good at are things I did not want to do. I did not want to touch. Those were the things that were burning me out. And he taught me and showed me that, hey, there is a way to get you out of the day-to-day. And he started bringing in some people and some other people that were coaching me and mentoring me and all that. So that's where I was like, well, if there is a way to do 5, if there is a way to get me out of the day-to-day, and if this gentleman who I got to develop a really good relationship with before he became a business partner can help me, why not do it? I take a few chips off the table if it doesn't work out. And then if it does work out, fantastic.
What did he offer you for the business?
Yeah. So he offered me, 66% ownership in the company, $1.5 million valuation. And then after that offer, he goes, hey, I have another partner that I want to bring in to take 33 or half of his 66%. And the gentleman that he brought in was another super solid guy, Major League Baseball agent. So he was connected, built businesses, like an Atlanta guy. So he just brought a different level of expertise and wise counsel to the table. And I was like, hey, better to have 2 partners than one.
Absolutely. So let me just understand the valuation. So he said, we'll put a value on it of 1.5 million. Got it. So at the time you're doing 35% on $1.7 million. So I'm doing the back of the math on that. Would have been like kind of like 3 times profit-ish.
That was pretty close. 3.5. Yeah.
Yeah. Okay. So he puts 3.5. He put a value on it of 3.5 times profit. It sounds actually more like SDE. Brokers refer to seller's discretionary earnings, but because it was also including your salary was also part of the profit of the business. Got it. Okay. So 3.5 times and so placed $1.5 million, but he didn't buy it outright 100%. He said, I'll buy 66%.
Yep.
Right. So Casey, here's a check for roughly $1 million. Go away, put that in the bank, but we want you to stay.
Yes.
It sounds like, and remain a shareholder. You hold on to 33%. I'll hold on to 33% and I'll bring in this other guy, former agent or agent who will also take a third. Yep. Am I getting the math roughly right?
Correct.
So you were still in the business. The third of your equity you rolled in. What about your salary? Did you remain an employee of the business, or did you kind of back away from?
I didn't even understand at the time, like an employee versus owner versus salary. Like I didn't even understand all of that stuff. So I don't think I got anything for maybe 6 months, and eventually I took I think it was like $3,000 a month salary to do this job, which, as you know, is probably shy of what I would normally have gotten back then in the normal marketplace. But I thought, hey, the only way I should make money is if the business is profitable. That's what I thought. But I didn't realize that I'm working 40, 50 hours a week in this thing too. So yeah.
What about your other 2 partners? Were they working 40, 50 hours a week in it, or was it more part-time for them?
No, the one gentleman was just there quarterly and monthly, and he was just more of a connector, right? So he didn't get like a ongoing salary. And Chad, my other partner, he he didn't take anything. I think eventually, maybe a year into it, when we got to like 2 or 3 locations, he took like something similar to what I did out on a monthly basis.
Got it. That makes total sense. So you've got 2 new partners and you've pocketed some cash, which is great. What happens next?
So we tried to fix some of the problems that we were currently experiencing in our one location, which was high turnover, which was Casey was the chief of everything. And
high turnover of, customers or staff?
Staff.
Okay, got it.
Because we weren't paying people enough. We had no benefits or anything like that. And Chad, who came in, said, hey, let's take care of our people. Let's pay people more. Let's take care of them. Let's tie them into the success. And he taught me a lot of things. So I think for the next 6 months or so, we just kind of steadied the ship a little bit, got me a little bit more emotionally healthy because I was experiencing burnout. And then new opportunities came up, and we knew that, right up the road in Marietta, which was 20 minutes away, would have been a great second location, kind of baseball capital and kind of Georgia.
Mecca,
yeah. And there was another gentleman up there that was a former professional baseball player, played with the Astros in the World Series, and he wanted to start a DBAT. So we kind of like mingled him in with the ownership group as well. And he realized, hey, I want to own it, but I don't want to run it. And he saw us as the ones that could run it. So he kind of got into the ownership group and took a small percentage. So I got diluted a little bit more. But ultimately, we opened that location up, and he didn't have to be the one hiring the people and managing the people and doing all that kind of stuff. He just got to own it. And then we had a grand opening, and it was another business that went out of business. Actually, it was the exact same kind of situation. Another failed academy. We took over a building. So some of the stuff was done. That build out was a little bit more expensive, but we did the exact same thing and put in the model.
And so now you've got 4 owners in this ownership group in 2 locations. How did the debt work? So the second location, you had to take over a lease. So there's a lease obligation there. You've got to make some leasehold improvements and fix up the facility. That costs money. Who guaranteed the debt? Or was the business at this point big enough to take on the debt? Like, just help me understand that.
We pulled out a couple lines of credit, and the other.
And who guaranteed that?
It would have been all 4 of the partners. Yeah.
Okay.
Yep.
So personally, all 4 of the partners.
Yep.
Even though Chad sounds like he was at a much later stage in life.
Yes, but we all kind of said, hey, if we're going to take a loan out, we all guaranteed it. And then the 4th partner ended up investing cash, which helped. And the line of credit wasn't a lot because we kind of knew how to get these things open for as cheaply as possible. But this next location, it was probably it was a significant build, but we all kind of put in our own line of credit and our kind of personal financial statement on the line and accepted a few more investment dollars.
What was the most challenging part of having an ownership group? Here's what my experience would be on this, in that when you've got people at very different stages in life, some people maybe liking the idea of a business, but not necessarily want to running in a business. Other people who, maybe just putting their name to it and connections, but not necessarily willing to like pick up the birthday cake and drop it off at the party. Like some of the kind of blocking and tackling associated with that. Like, how did you handle some of those conversations? I mean, am I reading between the lines here and saying that there must have been those tensions between the ownership group? No?
Yeah, it was messy. It was hard. The good thing was the ownership group was really wise and really mature, and they were super solid guys that didn't let money get in the way. Like these guys were salt of the earth kind of people, right? So that's where it's like you got to make sure you're going into business, especially if you're like in a partnership, like with people that are values aligned, that at the end of the day, if it all went to zero, you're okay, they're okay. So that was really important. And they were great there. I mean, I wish I knew then what I knew now around how do you structure an organization? How do you understand, okay, this is the position I'm playing and this is my role and this is my position and this is how you're going to get paid and this is what success looks like. And we didn't have that. I did my best, but it was really tough because everybody had a different thought or opinion or whatever. And not so much my first 2 original partners, but we had, other people that ended up joining the group a little bit later on when we went from 2 to 5, and we can talk about that. But then there's more ideas, right? And there's more voices. And that's when it got really hard. And we got maybe a little bit farther away from our niche. But looking at it, and when I go into companies now, it's like, all right, where are we going? Okay, what is our niche? What are we focused on as a company? And then who's doing what? And then how are we going to work and communicate? And we set that up really poorly. Could have improved on that. But at the end of the day, it worked because we were just people that cared about each other and didn't let some of that stuff get in the way. But it probably could have been done a lot better.
What triggered you to want to get out completely? And maybe just walk through how big you were and what was the genesis there?
Yeah, we went from the one location to the two, and then 2 to 3 to 4 and to 5. And as we grew, we brought in a few more partners here or there because building these things out took capital. It's not like you can just grow by hiring people. You had to hire people, and you had to buy leases or invest in real estate and improvements and guarantee leases. And at that point, I was like, hey, I'm good. I can retire. I'm fine. Financially, I was not wanting to take on more financial risk. And as I saw it getting bigger, there was more and more financial risk being taken on. We got to a point where we had 5 locations. It was a $10 million valuation at the time. And the good news, it's so much better today than it was even back then, because I think they started realizing, all right, well, what are the roles? What are the responsibilities? Who's doing what? And they ended up aligning a lot at the end. And then when I ended up exiting, I basically hired a COO to oversee it all. And we said, he's in charge. So it wasn't, all right, there's multiple people with multiple voices. There was multiple voices, but there was one person that was literally in charge of running the day-to-day. And he had an experience that was above and beyond what I had. And that's what I realized back in the day. It's just, if I would have brought other people in that kind of had operational experience, because I think my first couple partners, they were more visionary, which there's a book out there called Rocket Fuel. Have you heard of that book, John?
Yeah. Gino Wickman.
Yeah. And it talks about every business needs a visionary and an integrator. The visionary is the person that's ideas and future focused and everything seems great and they're really optimistic. And the integrator is more like, okay, hang on, this idea is great, but I don't know if we should do it this quarter, maybe next quarter. Or they're the ones that are writing down that vision, but making sure the vision happens by running the day-to-day and leading weekly meetings and looking all the KPIs and all of that. And I think we had a lot of visionaries, and I was probably the only integrator, but I was even more visionary. So it was really hard until we brought in somebody that was more like that integrator. And I ended up reading that book, Rocket Fuel, probably my last year in the business. And I wish I would have read that book at the beginning of our partnership. But you know what? At the end of the day, I learned a lot and it was still a super huge success for all parties. Probably a little bit messier than it needed to be. I wish I would have been probably a little bit more emotionally healthy at the time because I was so burnt out. But I was burnt out because I didn't hire and surround myself with good operators. I surrounded myself with good visionaries. But I think we were 1 or 2 other operators away from really taking it to the next level.
Got it. That makes total sense. I want to dig into a couple of things. So you get to 5 locations. The ownership group had diluted at that point. Where are you at in percentage terms at this stage of the game? You were at a 33%.
Yeah.
By the time you get to the 5, are you down to sort of single digits? Do you remember where you are?
No, roughly? I was just shy of 20%.
Got it. So you still got a good chunk of the business, and was there? I hear you on the general theme, which was the ownership group. As you grow, you're continuing to take on more and more obligations in the form of leases and debt, and you're continuing to guarantee those. Mm-hmm. You'd reached a point where you didn't want to continue to do that, and you wanted to de-risk a little bit, which I totally empathize with. Was there a straw that broke the camel's back that you're like, this is it? This is a bridge too far? Was there a renewal of a debt facility that can you remember what the actual thing was that made you think, you know what, I'm out?
Yeah, I think it was a little bit of the financial risk involved because it takes a lot of capital to build a capital intensive business. And I was having to guarantee debt that at the time, I wasn't the person that I knew I could make good on it, meaning I didn't have the control. I couldn't just be the one to say, all right, I'm going to run this thing and guys just get out of my way. And now I would have been successful doing it, but I would have burnt myself out again. But I didn't control my own destiny anymore because there was so many different voices that it was hard for me. And I already went on that journey once, right? Building it. Yeah. So I just wasn't ready to do it again. And for me, guaranteeing debt when I know like I'm not the actual person that's going to make it happen, right? That was tough for me.
Yeah, that's tough. And did you explore with a bank the possibility of allowing the business to guarantee the debt at this point? Like, was it large enough? Did you have those conversations with banks to say, look, we got to remove us as personal guarantors here?
Yeah. And I think we eventually got there, and probably now that's probably where it is. I just, I probably lacked a lot of the visionary vision that my partner had, because he'd already been down this road. He's already seen how these things can play out if you just follow the course. I just had it. And that's where I got a little bit, hey, I've done great. I got my capital here. I've made a lot of great relationships. Can I maintain great relationships with this team, help them potentially, and then exit in a graceful way? And that's what ended up happening.
You mentioned the $10 million valuation. Walk me through how you valued the business, like the methodology you used.
Gosh, it was a lot of like napkin type math, right? It was my partner and I, we just got together and we said, hey, look, this is where we're at. This is what's possible. This is what's kind of happening, because not every location at the time, I think our last one opened just recently opened. Now we opened with a bang, but it takes a little bit of time for these things to get kicking.
Sure.
So it was kind of like back of the napkin math. What makes you happy? What makes me happy? How can we maintain a friendship? And then we just worked it out together. And I got a check and we maintained a friendship, and we still do stuff together. I own a piece of the real estate in one of the locations, right? Because that was kind of nice. And I wanted the business to succeed. And I realized at that time I was holding it back, and I had my person that I knew could kind of do better than I could. And I put him in there, and it just worked.
And usually in these deals, there's sort of a payment over time. So how did you structure the if I'm doing the math right, $10 million valuation, 20%, a couple $1 million, a big check for a company to write. Did you get a check over, like, did you get paid over time, or how do they structure the payments?
Yeah, it was pretty much. There was a little bit up front and then some over time. And I didn't want to put a burden or a debt on, the team. But that's how it was structured.
And in that kind of structure, you're a little bit exposed to the business continuing to succeed when you're gone. How did you get comfortable with that risk? Because again, the reason you wanted out was you were, all this risk you didn't necessarily control the outcome to, but you were essentially signing up for that in agreeing to get paid over time. So how did you get comfortable with that idea that these payments were going to get made?
Yeah.
Does that make sense?
Yeah. I took enough up front where I knew I would be good if for some reason something happened. So I was kind of good with that. And then I knew I had somebody in there that could run it now that was going to be better than I was. And I interviewed that person and, over time, and I saw him in action. And I think that's where, looking back at it, if I could have brought that person in earlier, created more clear roles, responsibilities of what he does and what I do, right? I might still be in the business today. And that's not how it worked out, because I didn't know, right? But we just didn't have that clear alignment. And I was still probably doing a lot of things in the business that I didn't love to do. And I was just like, all right, if I can remove myself from that, go take my experience and learn from others and help other people do it even better. Because what we did was amazing. But I'm always like learning and trying to figure out next time, how do we even do it better?
A lot of people listening to this will have considered, maybe even had a false start around the idea of hiring a chief operating officer, an integrator, to use your lexicon, a general manager. What experiences can you share, or even advice for somebody who's just about to hire a COO or integrator? Like, what makes a great integrator? What are some of the mistakes people make when hiring a general manager? What advice would you give?
You got to align on vision and values first. So you just got to get really clear in your mind of what is the vision for the business. 3 years from today, what does it look like? A year from today, what does it look like? Are you trying to exit? Are you trying to build something that doesn't rely on you having to be there? So like, get really clear on what the vision is. And I find a lot of owners don't have that. Like, it might be clear in their head, but it's not written on paper. And if it's not written on paper, right, it's like tough. And visionaries are very optimistic. And I think, even taking that vision and asking somebody else, well, what do you think of this? Is this possible? Right? I think is good. So clear on vision, clear on value alignment. You got to have vision and value alignment. But if they're good on the vision and they're good on the value side, but they don't have the skill set, it just doesn't matter. So, a good integrator or COO is great at managing people, and they're great at making sure stuff gets done, like the right stuff gets done. So you need somebody that loves waking up every day and kind of doing the same thing 10,000 times over and over again, where visionaries like to do one thing or 10,000 different things one time. So you need somebody that's very process driven. They like going and waking up at the same time and going to the office and doing the same thing and reviewing employees and hiring people and managing people. But yeah, I mean, what type of person? It's somebody they got to love being around every day, or at least being in a relationship with, because you're going to talk to this person a lot. Don't just hire somebody because they got the skill set. Hire them because you have some kind of connection where you see yourself enjoying working with them. And then hire somebody that has a proven track record of actually managing before. Because if you hire somebody that hasn't done it, you're kind of gambling to see, can they turn into that person? So have somebody that, I believe, depending on the business. Now, if it's $1 million business, maybe you can hire somebody that has potential, but they got to get it pretty quickly. If you got to teach them a lot, that's tough. People either get it or don't. And just, kind of invest and align with them and figure out what they want. Because if you can help them get what they want, they'll help you get what you want. So hire somebody.
Sorry, Casey, I didn't mean to cut you off. I wondered, do you use any psychometric testing or any assessments that you would use to evaluate a COO?
Oh my gosh, I got them all. I use the 𝙁𝙊𝙐𝙇𝙊𝙀 assessment is one of them. There's an assessment I use that's literally a visionary integrator assessment. That's more kind of the way that I look at it, where it asks certain questions from the visionary and integrator of their strengths and weaknesses. And I try to actually compare each of them, right? Because I mean, it's kind of like you're finding your business spouse. And as a lot of people know, marriage is tough, right? Most marriages fail. Most business partnerships fail. Most COO, CEO, visionary, they just don't work because they don't do the work up front to figure out, is this the right person, and align on what does success look like and what's my role versus your role going to be in the business.
So 𝙁𝙊𝙐𝙊𝙁 is one that I'm quite familiar with. So it's based on 4 personality attributes: fact finder, desire to seek out information before making a decision, follow through, patterns, desire to create systems, quick start, new ideas and vision stuff, and then implementer, right? I think it's called implementer. Is that the 4th one? Implementer, which is good with your hands, physically able to build models and stuff like that. So of those 4, what and 𝙁𝙊𝙐𝙊𝙁, for folks who are interested, you score everybody. Everybody has a little bit of all 4 attributes in them, but you have sort of tendencies towards one or the other. So you score each other. You get a score from, I think it's 1 to 10 on each attribute, right? So what would you be looking for in a COO, a chief operating officer, 2IC integrator, on those 4 metrics? Fact finder, follows.
Yeah. So that fact finder is your need for information. So I want a COO to need a lot of information before they can take action. And this assessment is all about how you take action and get something going. So a fact finder is they need a lot of information. I don't love
7 plus.
Yeah, 7. I would say 6 plus. If they're a 9 or a 10, that almost scares me because it's like, man, they are going to analysis paralysis. So I like in that 6 plus. If it's a 9 or 10, I like it, but I also have some questions. And then looking at follow through, that's systems. Their need for systems and structure and organization, it's got to be a 6 plus. Because I want somebody that if they're working with a visionary and says, hey, let's go do this, they're like, hang on, let me slow down and ask some questions to clarify, should we do it? What's the best way to do it? And then let's put a system in place to make sure if we do this, we do it the right way, in the right order. And those 2 things are the most important for any integrator.
Quick start.
Quick start. A lot of quick starts, like mine's a 2. Now I'm kind of visionary, so I'm kind of weird. I'm willing to go and take risk, but I have to have all the information. So you have to have a CO or integrator that's willing to go. That's not just stuck and scared. But I like a quick start to be a 2 plus. If they're like a 1 or even a 2, you just got to make sure they're like, they're willing to work in an entrepreneurial business. Most of your listeners, like that's entrepreneurial type companies, are not big corporate entities where you can hide. Like the integrator or COO has to be able to get stuff done. They can't just be stuck in research and fact find all day. They got to be willing to go. So quick start, it's typically like, a 2+. If they're like a 6, 7, 8, or 9, I'd be wondering, are they even an integrator? Because I don't love COO integrators to have like a 9 or an 8, because that's them wanting to take risk. And if the visionary of the company, or you listening to this as an entrepreneur, you're probably high in risk taking. Well, if you partner up with another risk taker, good luck. You guys are going to take some risk. But if you don't have the systems or the processes, it's going to be tough.
And an implementer, do you care?
I don't really look at that one all that much. It's more for like engineers and stuff like that. It's people like working with their hands. I don't use that one as much.
Yeah. And for folks who want to dig deeper into this, one of the other things, in case you did a great job of describing it, but if you're working with someone where there's a huge gap between the numbers, like for example, if you're a 9 quick start and you hire a 1 quick start, although you may think, oh, that's perfect because I'm really big on ideas and the 1 is going to be super conservative. The problem is, you may look at each other like you have 2 heads, like it's like you speak a different language. So it's good to have variance, but not too much variance. So, like a 7 and a 4 would work well together. Like you could appreciate each other's strengths, but still sort of row in the same direction. Whereas like a 9 and a 1, that's going to be like oil and water. Tough to make that work. Thank you for the deep dive on Colby for folks. I'll put Colby stuff in the show notes too, if anyone wants to dig deeper into that. This is great, Casey. Are you up for a quick lightning round before I let you go?
Let's do it.
Okay. So you've had a lot of dealings with investors, potential acquirers over your time with 𝙁𝙊𝙐𝙇. And so I'm asking this from the standpoint of, you can look at it from potential acquirers of the entire business or investors in the business. But what's the slimiest trick an investor or acquirer has tried to play on you?
The slimiest trick.
I try to take advantage of your naivete, trying to kind of get one over on you.
I don't know. I'm really good at the fact finder. My fact finder's high, so I ask a lot of questions, and I can kind of tell by now who's real and who's not. But I think it's the lure of money, the lure of more. Like they're trying to get you to realize, wow, it's so easy. I think like nothing's easy. Nothing is as good as it seems. And there's always like things below the surface of what a lot of people are telling you.
Got it. So you've had sort of 2 exits. The first being when the business was just the 1 location, you sold 66%. So you can use that as an example. Or the second exit where you were a minority shareholder in a much larger business. But what's the biggest mistake you made personally in the process of selling your company? Again, choose either of the 2 sales, if you will. But what's the biggest do-over you'd like to have?
I wasn't emotionally healthy during any of that period of me building that business. I wish I probably would have brought somebody on to be some sort of, I went to, a Christian counselor for 2 or 3 years while building this business. And at the end of that 3-year period, I was like free and my mind was clear. And I just had a lot of baggage from previous life experiences that I didn't get over of. So I think it's just making sure you're healthy, right? You're healthy in your relationships at home. You're healthy in your relationship with yourself. Because I wasn't a healthy person, and unhealthy people, whether it's spiritual, mental, physical, emotional, if you're unhealthy, you're going to make unwise decisions. And I think I was at a high level of stress. So anybody that could take a step back and say, all right, how do I de-stress? How do I get my mind thinking clearly? Because I think a lot of people, entrepreneurs that are in the fight, building, thinking about selling a business, it's a very stressful thing. And when you're making decisions under stress, it can be dangerous.
Yeah, no, for sure. And for you, I'd love to know in your own personal experience. And again, I want to really isolate the process of selling rather than the process of building 𝙁𝙊𝙐𝙇, which I know took years. I'm thinking of just that window of time where you were negotiating the sale, whether it was the first or second. What was the lowest emotional ebb you reached? Like what triggered the lowest emotional ebb you reached during the process of selling?
I think it's my identity, because now what? right? I'm selling this business. Now, what am I going to do? Now, who am I? And I remember we had a gentleman, this was in the process of me exiting after I hired my replacement. And one of the gentlemen that I hired, he actually passed away in an accident. And I remember all of the guys that I hired were getting together at the facility, and I already hired my replacement. I'm like, should I go? Should I not go? Am I a part of this team? Am I not a part of this team? Like, I cared about these people, but I didn't want to get in the way of the new leader that I just put in place to help these people. So I think for me, it's my identity was tied a lot probably to the business. And that was another one of those things that I worked through that, hey, I am not my business, right? That doesn't define me. So I think that was probably it. And I think a lot of people that exit a company, they're stuck. And the day they sell might be great, but it's like 3 weeks later after they've done their golf and done their trips, like, what do I do now? So I think that was probably it.
Yeah. Well said. And what about the highest point? Again, if we isolate the actual time where you were selling the business, either the first or second time, what was the emotional sort of height you reached?
I just remember I didn't have to do any of the things that I didn't like to do anymore. And there was a lot of things. You know, I always tell people you want to spend 70% of your time doing things that you love and you're great at, and 30% of the things that you're good at, but you don't like doing. And I was probably inverse of that because I was not willing to bring on, the right people or at least the right counsel to help me. So I think it was like, hey, I don't have to answer that phone anymore, right? I don't have to do that thing anymore.
And was there one, it sounds like you're generalizing, but I'd be curious to know, was there one moment in time, like one angry customer or one like that you remember, I don't actually have to deal with this? Like, was there one moment that that you had that realization?
I'm a great leader of people, but not a great manager of people. And when you're managing young 20-something-year-old former professional baseball players that are now instructors, and they take a lot of coaching and a lot of help and a lot of handholding, and that wasn't my personality, I was like, I'm glad I don't have to manage them anymore. I miss leading them and connecting with resources, but teaching guys to show up on time for their baseball lessons, right? Teaching them, hey, after your lesson, you should probably write a thank you note and put it in the mail and thank your client, and make sure you call them if they haven't rebooked in a week. So managing people and personalities, at least, us baseball guys and professional athletes, they were hard.
That's really funny. What about any resources you could point our listeners to, in particular around the process of valuing and selling a company? Again, I've made a note of Rocket Launch, so we'll put that in the show notes for sure. Are there any other speakers, forum mates, courses that you went on, anything you could sort of share with our listeners that was helpful for you?
I sought out other people that already had exits, and I had a list of, 2 or 3 guys that I relied on. So I would just say those people are probably already in your network. There wasn't like a guru or a thing. Like, I wanted a real person that had already been through it. And I wish I probably would have joined some kind of peer group probably earlier, because I probably would have made some different decisions. But I think that's probably it. There's all kinds of different peer groups out there that are other CEOs and entrepreneurs that are going through it. But I just had a couple close friends that kind of saw things a different way. And I think that's what's important, is surrounding yourself with other people that might give you advice you don't want to hear or ask you questions that you don't know of asking, of yourself.
What about a trophy? Did you reward yourself with any sort of physical trophy that commemorates the win?
I remember like going and test driving like a Porsche, like after I exited, and this was like the first time. And I was like, I don't need a car. Like, that's not going to make my life better. And I just stuck with my Honda CR-V. Now I don't even own a car. I kind of borrow my wife's when I need it. And we're about to upgrade to a minivan. So I guess I'll be borrowing her minivan sometime soon. But no, I mean, I just love relationships and people. So I think just doing things with friends, like, hey, let's go to this sporting event, or we went to the World Series. I mean, we've kind of done all the fun sports events that are out there to do. And a lot of times I'll just invite friends for free, and you don't even have to pay for it, kind of thing. I kind of like doing that.
Yeah. Which World Series game did you see?
We went in 2016. We went to game 3, 4, and 7 of the Cubs versus Indians.
Wow.
Yeah.
Wow.
And
that sounds like
we lost 3-4, and we're like, we're out. We're down 3-1. But I kept saying, we got a chance. We got a chance. And in game 7, it happened. I'm like, we got to go. And me and 4 of my buddies went, and Cubs got the W.
There you go. You're there you go. You're living the dream, which is great. I'm super grateful for you sharing this story, Casey. And where can people find you? Are you a LinkedIn guy? Do you have a social?
Yeah, I'm on LinkedIn. I'm on Twitter, just 𝙁𝙊𝙇𝙇, and then 𝘎𝙤𝙇𝙊𝙇𝙊𝙀.com. Check it out there. I got a newsletter I publish every Friday to help entrepreneurs focus. And we got a podcast too. I love baseball, as you know. So we have the Dugout CEO podcast where, it's baseball guys, but they're business guys and they're helping people win on the field, off the field, in the boardroom kind of thing. So the podcast is rather new, but I think we're 20 episodes in, and we've had some former Major League All-Stars and Hall of Fame coaches. It's been a ton of fun. And my whole goal is to get entrepreneurs the resources they need. And all that's at 𝘎𝙤𝙇𝙊𝙇.com.
Awesome. And congrats on the show. I know it's early days, but you've got like 85 5-star ratings or something like that. It's incredible to be at that stage of the game in such an early part of the episode. So Casey, thank you so much for doing this. We'll put all of Casey's contact information and the resources he mentioned in the show notes at builtthisout.com. Thanks for doing this.
You bet. Thanks, John.